The screen flashes red, a waterfall of falling prices, and a cold knot of fear tightens in your stomach. Every instinct, every headline, every panicked voice on social media screams one word: sell. The stock you believed in is now in a freefall, and it feels as though the floor has completely vanished. The uninformed participant sees this cascade of red as a sign of impending doom, a signal that the company is failing and the price is headed for zero. Their emotional response is to join the herd, to sell their shares at any price just to make the pain stop. They see the volume bar on their screen swell to a massive size, the largest in months, and they interpret this as confirmation of their fears. They think, everyone is selling, the ship is sinking, I have to get out now. This is the moment of maximum psychological pressure, the point where rational thought is overwhelmed by the primal fear of total financial loss. But what if that massive volume, that frantic activity, is not what it appears to be? What if the story it tells is the exact opposite of what the crowd believes? The market is a machine driven by the law of supply and demand, and nothing else. Every transaction has two sides: a seller who is fearful or taking profits, and a buyer who sees opportunity. When you see a period of intense selling, the critical question is not who is selling, but rather who is buying. In a panic, the sellers are the public, the weak hands, the people driven by emotion. The buyers, however, are the large operators, the professional money, what Richard Wyckoff called the Composite Man. This is a metaphorical entity representing the collective mind of the most informed, well-capitalized market participants. They do not operate on fear. They operate on value and logic. When they see a quality asset being sold off in a panic, far below its intrinsic worth, they do not run away. They begin to absorb the supply. This brings us to the concept of stopping volume. It is the footprint of the composite man in the snow. It is the first tangible evidence that the overwhelming force of supply is finally being met with an equally powerful, yet much quieter force of demand. The massive volume bar that terrifies the amateur is, in fact, the record of this immense transaction. Millions of shares are changing hands, moving from weak, fearful accounts into strong, patient ones. The defining characteristic of stopping volume is not just the high volume itself, but the relationship between that volume and the price action. This is the law of effort versus result. The effort is the volume, the immense number of shares traded. The result is the change in price. In a healthy downtrend, a large amount of selling volume, effort, should produce a large drop in price, result. You would expect to see a long, wide red bar. But with stopping volume, something different happens. You see a colossal amount of effort, but the result is small. The price bar itself is short and compressed. It may open low, drop a little, but then it battles its way back up to close far off its lows. The immense selling pressure was met with so much buying that the price was unable to continue its collapse. The brakes have been applied. Imagine a heavy train hurtling down a steep hill. For miles it picks up speed, unstoppable. Then you hear a deafening screech of metal on metal, a sound of immense friction and force. The train, despite its momentum, shudders and slows dramatically over a very short distance. That screeching noise is the volume. The sudden deceleration is the price action. An outside force has intervened, a force powerful enough to halt the momentum. That is precisely what stopping volume represents on a price chart. It is the first signal that the character of the market is beginning to change. It does not mean the downtrend is over. It simply means that for the first time, a formidable opponent has stepped onto the battlefield and absorbed the first wave of attack. The sellers have thrown their biggest punch, and the price refused to fall to the canvas. This is a profound shift in the underlying dynamics. The panic selling of the crowd is being used as an opportunity by professionals to accumulate a large position at wholesale prices. They are not trying to push the price up yet. They are simply content to act as a giant sponge, absorbing all the shares that frightened traders are willing to give away. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom, presented in the Annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding these foundational texts is not a shortcut, but a requirement for anyone who wishes to move beyond guessing and into the realm of professional speculation. The market speaks a clear language, and these resources are the dictionary and grammar book for that language. So how do you learn to see this pattern in your mind's eye, without being swayed by the noise of the moment? First, you must establish the context. Stopping volume is meaningless in a sideways market or a gentle uptrend. Its significance comes from its location. Picture a stock that has been falling for weeks. The price has been making a series of lower highs and lower lows. The bars are mostly red and many are long, showing that sellers are clearly in control. There is a sense of despair surrounding this asset. Now visualize the climax of this move. The selling accelerates. The price gaps down at the open. It feels like a capitulation. On this day, or over a few days, you witness a dramatic expansion in volume. Imagine the volume bars at the bottom of your mental screen. They have been average height for weeks, and suddenly one appears that is 2 or 3 times taller than all the others. It is a skyscraper in a neighborhood of bungalows. Now look at the price bar associated with that skyscraper volume. Instead of being a long, destructive red bar that closes at its absolute low, it is a short, stubby bar. Its total range from high to low might be large, but the distance between the open and the close is very small. Critically, it often closes in the upper half of its own range. This shows that despite the flood of selling that occurred during the session, buyers stepped in with enough force to push the price back up before the close. The sellers could not hold the price down. This visual contradiction, giant volume, small price progress, is the fingerprint of stopping volume. Recognizing this pattern is one thing, acting on it is another. A common mistake is to see the stopping volume bar and immediately buy, assuming the bottom is in. This is premature. As Jesse Livermore taught, one must not anticipate, but wait for confirmation. The market does not reward haste. The stopping volume bar is merely a signal to pay very close attention. It is the setup, not the trigger. The professional has now absorbed a large amount of stock, but they need to be sure that the selling pressure is truly exhausted. They are not interested in fighting an ongoing waterfall of supply. So, what happens next is the most critical part of the sequence, the test. After the initial drama of the stopping volume, the market will often become quiet. Over the next few days or even weeks, the price will drift back down toward the low of that stopping volume bar. This is the secondary test. This is the moment of truth. The crowd sees the price falling again and thinks, I knew it. The decline is continuing. But the professional is watching one thing and one thing only, the volume on this retest. If the supply has truly been exhausted, this drift back down to the low will occur on very light, anemic volume. The volume bars will be tiny, some of the smallest you have seen throughout the entire decline. This is a condition Wyckoff would call a lack of supply. It tells you that there are no more aggressive sellers left. Everyone who was panicked into selling has already done so. The tank is empty. This low-volume test is the confirmation you have been waiting for. It validates the original hypothesis that the high-volume bar was indeed stopping volume. It signals that the path of least resistance is beginning to turn upwards. Therefore, the action plan is one of patience and precision. First, the setup. You must identify a stock in a clear and prolonged downtrend. You're looking for a fish in a specific part of the river, not casting your line randomly into the ocean. Second, the signal. You observe a day of massive climactic volume accompanied by a narrow price range or a bar that closes well off its lows. This puts the stock on your immediate watch list. But you do nothing. You simply watch and wait. Third, the trigger. You wait for the secondary test. The price must return to the area of the stopping volume low, and it must do so on significantly diminished volume. The trigger to act is not on the way down, but when the price proves it can hold that low and begins to turn up again. A safe entry would be to place a buy order slightly above the high of the small, low-volume test bar. You are entering only when the market itself confirms that demand is beginning to take control. Protecting your capital is paramount. Your thesis is that the low of the stopping volume bar represents the line in the sand drawn by institutional buyers. If they are truly in control, they should not allow the price to fall significantly below this level. Therefore, your protective stop loss should be placed just below the absolute low of that stopping volume bar. If the price breaks that low and continues downward with any sort of conviction, your analysis was incorrect. Perhaps it was not stopping volume, but merely a pause before a further decline. By placing your stop there, you have a logical, objective point of exit. You accept a small, manageable loss and preserve your capital for the next opportunity. You do not argue with the market. You do not hope for it to turn around. You simply acknowledge that the evidence changed, and you act accordingly. This removes emotion and ego from the equation, which is the only way to survive long term. Now we must consider the variations. What if the market does not follow this ideal script? What if, after the stopping volume bar, the price retests the low on high volume instead of low volume? This is a significant warning sign. It tells you that despite the initial absorption by large operators, there is still a substantial amount of supply entering the market. More sellers are still emerging. In this case, the bottom is not yet confirmed. The professionals may need to allow the price to fall further to shake out these remaining weak hands, or they may abandon their buying campaign altogether if the selling is too persistent. High volume on a test negates the setup. You stand aside and wait for more clarity. The absence of a signal is, itself, a signal to do nothing. Another scenario is a failed stopping volume pattern. The initial bar appears correctly. The secondary test may even occur on low volume, but then the price fails to rally. It just sits there, lifeless, or begins to slowly roll over and eventually breaks the low. This indicates that while demand was present, it was not strong enough to overcome the broader weakness in the market or the latent supply within the stock itself. This is why a precise entry trigger, buying only as the price begins to move up from the test, is so important. It prevents you from entering a stock that is not yet ready to move. Remember, the goal is not just to avoid losing money, but to employ capital in situations where the probability of a significant move in your favor is highest. A stock that is not rising is dead money, and it carries the risk of eventually resolving to the downside. Patience is not just about waiting for the setup, it is also about waiting for the move to actually begin. In conclusion, the phenomenon of stopping volume is a powerful lesson in looking beneath the surface of market action. It teaches us that the crowd is almost always most emotional and therefore most wrong at the major turning points. It is a tool for calibrating our perspective, for shifting from the mindset of a fearful participant to that of a cool, calculating observer. It is not an infallible signal because no such thing exists. Instead, it is a critical piece of evidence in a larger puzzle. When you see it, you know that the dynamics of supply and demand are undergoing a potentially seismic shift. You know that strong hands are quietly replacing weak hands. Your job is not to jump in front of that process, but to wait for it to complete its initial stages, to wait for the evidence of seller exhaustion, and only then to align your actions with the emerging strength. The market is a story written in price and volume, and each pattern is a chapter in that story. If you wish to continue learning the language of this story, stay with us.